JoAnna Ignace, Coldwell banker, Dallas Real Estate. Today, we're going to talk about deductions when buying a home and the new tax changes in 2019. Please don't forget to subscribe, comment, and like. Check that little bell below. Ring it. Let me know what you think. Can you believe tax season's just right around the corner? Yep, and to make it more interesting this year, we're going to talk about how the new tax law affects mortgage interest. The code has changed. Along with these new rules, about the tax deductions for homeowners, what is the biggest change? Many homeowners were used to be able to write off their property taxes and the interest they paid on their mortgage. Some of those are no longer going to be able to. But stay calm. That doesn't automatically mean your taxes are going up. I'm going to give you the details below and how this rule is going to affect you as a homeowner and what the biggest change is to expect. Stay tuned. So what is the big change? The standard deduction, the amount that everyone gets where they actually deduct or not. That is nearly double under the new law. It is now $24,000, up from $13,000 for married couples jointly filing. It is $18,000 for heads of household, up from $9,550. And $12,000 for singles, up from $6,500. Many people will get a better deal taking the standard deduction than they would with the itemized write-offs. For perspective, the number of homeowners that will be able to deduct their mortgage interest under the new law will fall from 32 million to 14 million. The federal government says that is about 56% drop. Evan Liebert, a CPA and director of the federal tax policy for the National Association of Realtors in Washington, D.C., says this doesn't necessarily mean they'll pay more taxes. It just means they'll no longer get a tax incentive for buying or owning a home. So will you be able to itemize or will you do the standard deduction? Look at the link below. It's a calculator that will give you an estimate. If the answer is a standard deduction, you'll be pleased to know that the forms are easier and you don't have to itemize. Again, the instructions for the IRS 1040 are in my links below. Don't forget to check those out. One thing to be aware of is that the increase to the standard deduction for homeowners and non-homeowners is that the personal exemption was repealed. No longer can you exempt your income, the $41,150 for each member of your household, and that might temper the benefits of a higher standard deduction, including on your particular situation. For example, a single person might come out ahead. They have $5,500 in the standard deduction. It is more than the $4,150 lost by the personal exemption repeal. But consider a family of 4 with 2 kids over 16 in the 22% tax bracket. They no longer have a personal exemption totaling $16,600. Although increased in the standard deduction is worth almost $2,240. So basically take $11,000 times 22%. The loss of the exemption would cost them an extra $3,652. So they lose $1,232. But say their kids are under 16, giving them a child credit worth $2,000. That offsets the result in only a $758 tax credit. The big takeaway here is your family composition will affect your tax status. So are you enjoying this? How about some salt in the wounds? Ouch! actually, SALT is CPA lingo for your state and local taxes you pay, like income, sales, and property taxes. They still have an itemized write-off. The tax changes for 2019, that's the tax year of 2018, means you can't deduct more than $10,000 for all of your state and local taxes combined, whether you're single or married. It's $5,000 per person if you're married but filed separately. Ouch, that's a little salt in the wound. The SALT cap is bad news for people in areas with high taxes. Thank goodness Arizona taxes, state and property, are fairly low. The majority of these homeowners in 20 states, over 20 states, have been writing off more than $10,000 in SALT each year. So they're going to lose some of this deduction. It's really going to hurt the tax areas like New York and California. An expert for the turbo tax in California says New Yorkers, for example, had SALT deductions around $22,000. They lost almost 50%. That's going to hurt their bottom line. So, but a positive on that is the rental property tax. There is no change. So if you're a landlord and there continue to be limits on the amount of mortgage debt increased state by state, you can write off on rental properties. You can keep writing off operation expenses like depreciation, insurance, lawn care, and utilities. So you might want to consider buying an investment property. Homeowner equity loans. Ouch, big change. How many of you have taken out a homeowner's line of credit on the equity in your home? You can continue to write off that interest and home equity if you itemize, but only if you use those proceeds to substantially better your home, and only if the total combined with your first mortgage does not go over the $750,000 cap. If you use the home equity loan to pay medical bills, to take a cruise, or anything else, then the homeowner's improvements, that interest no longer is tax deductible. Another problem with this one, the new rule does not grandfather in old home equity loans if the proceeds were used to pay something other than the substantial loan improvement. So if you took a loan out 5 years ago to pay your child's college or to pay off debt, you need to stop writing off that interest. Ouch! Now that we've gone over the highlights, I'm going to give you some tips for navigating the new tax law. A single person may get more of a tax benefit from buying a house. They can often and potentially exceed the standard deduction more quickly. So if you need help with that, let me know. You can check the tax, how much you're likely to owe or get back under the new law on this new tax calculator. Check the link below. It's a cute, easy to use little calculator. Student loan debt is deductible. Well, some of it is. Up to $2,500. That one blows me away. I don't know of any student with only $2,500 in student debt. If you're repaying, whether you itemize or not, you get to deduct that $2,500. Charitable deductions and some medical expenses remain itemizable. If you're a big giver and you like to help those charitable companies, or if you had a big year in medical bills, add to your mortgage interest may be enough to bump you over the standard and into the write-off zone. If your mortgage is over $750,000, pay that sucker down so you don't eat the interest. You can add a little to the principal payment each month or make one additional payment a year. You'll be surprised how fast your mortgage will go down. And oh my gosh, I don't know very many people with a $750,000 mortgage. I can't even imagine what that payment is. I hope you enjoyed this. Please don't forget to comment, post, like, and please feel free to share it. Thanks!